What happens if my put option gets assigned is the topic of this conversation, ladies and gentlemen. Welcome to I Have Success. You can check out the website, ihavesuccess.com. It is a website dedicated to helping you learn to sell cash secured put options on stocks you'd be happy to own. 2023. Almost getting ready for 2024. If you got an internet connection, a bank account, you spend money at least once a year, you have no legitimate reason not to understand this strategy. And if you're not already capitalizing in the markets, you have no legitimate reason not to be doing this. At the 1 minute mark of this video, a link to a different video will pop up right here. It is the unfair advantages of selling cash secured put options. Boom! There it is. Now, I'm sorry to be the bearer of bad news, but in this video that you can watch at the 1 minute mark after this video, you might have to be a little open-minded. I know that's a difficult thing in 2023. I know in 2023 there's a lot of screaming and crying of phony open-mindedness. This will actually require true open-mindedness. But if you are ready to challenge your mind, then when this video is done, go back to the 1 minute mark, watch that video, and see how selling cash secured put options on stocks that you'd be happy to own can benefit your financial statement. What happens if your put option gets assigned? Well, golly gee by Jiminy Cricket Willikers. I just happened to have gotten assigned. You see this 100 shares right here, quantity plus 100. This put option that expired on Friday. It is, boom, Saturday. You can see right here, Friday was the 26th of May in the year 2023. And now we're on the 27th. So yesterday, this option expired in the money. And I had a strike price at $67. And forget how much premium I took in to sell this option, but nonetheless, I got paid. And I wanted to take ownership of these shares, or I was happy not to take ownership of these shares. I really didn't care. So I kept the premium either way, and now I have these shares. So what I'm going to do now is I'm going to sell a cash secured put option against it. And it is XLU. It is a ETF for utilities. You can see over the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 10 trading days, it took a dive down. It closed here at $64.59. I bought it at what price? Do you remember? Boom, 67. And you know what that means? I hope you know what that means. I'm underwater by 241 big ones, smackers, USD, fiat currency notes, all of the above. Now we're going to right click here. We are going to move this over to long stock. Bam. All right. Now that should hopefully be falling under, getting out of there under that unallocated. All right. It's still there for now, but look at this. It's just slowly going to wherever unallocated stuff goes when options expire. I don't know, somewhere in the digital graveyard, but that will not concern us because here we go. There were some other options that expired and worthless, but we were assigned, we being the, I don't know what you want to call it, the royal we, being whoever watches these videos and myself. So we're underwater, right? We're underwater. And now is a good time to tell you that this is not financial advice. I am not recommending that you trade XLU. I'm using all these 12 ETFs as just mechanical representations of what to do. Maybe a better way to say it is just to show you the mechanics. It is not to say that this is a good underlying stock to trade on. Right? It may or may not be suitable for you. You need to figure that out for yourself. We're looking at a 1 month chart with 1 day. So we got about 1 month of 1 month of trading data, and each candle is representing 1 day of trading. Right, we see we had these two big candles right here that started the sell-off. It kind of went sideways. It sold off more as it started dropping down here. This candle right here looks similar to this candle right here. So does that mean that we'll see some more sideways motion than selling off? Maybe. This is a big, this blue candle is probably a weird color. It's probably supposed to be red. But nonetheless, you see how there's a big spike in volume right in here. This was probably some institutions in there. And actually, maybe this candle is supposed to be maybe green. I don't know what that color is supposed to be. It's definitely not supposed to be blue. It's supposed to be red or green. But nonetheless, we see this tail right here, tail to the bottom, right? It closed a little higher than it opened, but still price is in the bottom 10% of the body of this candle right here. And we're way off from where we were here. Let's take a look at some longer time frames on it. XLU. By the way, since my cursor is right up here, this is a simulated trading account. And before you ask me why are you using a simulated trading account, because if you are not proficient in trading, you should be using one too. And I lead by example, my friends. That's how your good buddy Brent does it. I lead by example. And so back to the program here. Now we're looking at 6 months of data, each candle still being 1 day, and we still got that 200-day moving average up. Boom, we see right in here, right? So why did your good buddy Brent sell this at 60, 67? Because I kind of wanted to get a sign so we could do something. And it worked, right? We did get a sign, but we see, looking at the last 6 months, it seems to pivot around this $64 area. If past can be a hint of the future, it is not a guarantee of the future, but it could be a hint. We might expect it starts bottoming out and maybe going a little higher. You know, maybe it goes a little lower. We'll see. Because this is a ETF of utilities, I doubt that it's going to go to zero. Let's take a quick look at last year. Okay, so during the last 12 months of trading, it got down here to as low as 60. What's this right in here? 62. So if it breaks here, we could expect it probably going down here to 62, and maybe as low as 60 if it keeps going to the downside. Now we're looking at 5 years on a weekly chart. So we got 5 years over here, and each candle represents 1 week. Now we can really see. Look at this. The 64 seems to be some pretty strong support resistance type of area, right? We've seen it happen quite a bit in here. In the last 5 years over here, 2000 year of the pandemic, it got all the way down to 43. So now let's do a looky poo at, and look at that. You know, that's on the week. Still. Anyways, so I bought it at 67. We see resistance here at 70. I see right here 70 seems to be support. Prices overlapping. Okay, support. Kind of prices overlapping. Seems to be some resistance. Right there. So 70 seems to be a place that if I wanted to keep the stock when I sell the put option, the call option against it. If you don't know what a call option is, we will get to that part in a minute. Let's look over here at the year. So I bought at 67. So I'm probably gonna look at this. 68, a little bit of support resistance area. But see, with what I have, what I'm doing right now, I'm kind of playing more of the wheel strategy. Meaning, I'm really not trying to hold on to XLU for the long term. Right? Let's say I sell it at 68 and it runs up to 70. You know, okay, I miss out on a couple $100. I don't really care. I still profited. Right? I'm okay with leaving money on the table. I just want to be profiting. And right now I'm underwater. So I want to start bringing in premium. So I got an idea. Now, if I was going to be trading with real money, I would look at a lot more information. In fact, I'd probably be looking at least one time at all these different charts. And you can see this is 1 day, 5 minutes. This is 2 days, 15 minutes. This is 5 days, 1 hour. This is 6 months, 1 day. This is 1 year, 1 day. This is 5 years, 1 week. 15 years, 1 month. These have what I consider all the moving averages, all the moving averages that I want to look at. Let's take a quick peek at those. See where it's at. Boom! Look at, I quickly can see it's below all the moving averages. So probably going to have a hard time getting back up. Or a little, at least getting back up here. It's got, moving averages are not support and resistance, but they can act as support and resistance. Just like I'm not your adopted father, but I could act as your adopted father if I adopted you. Even if you're older than me. How about that one? Yeah, ching, or whatever that drum beat is. But I'm not adopting anyone. I got enough stuff on my plate. And we can take a look at this. And might as well quickly take a peek at the volume profile. All right, so looking at 1 year, 1 day, wouldn't be surprised if price kind of stays in here, but also wouldn't be surprised if price moves back up to here. Right? When we look at a little bit longer of a time frame, looking at 5 years on the weekly, look at that. No surprise, price is right here. So maybe price will kind of flicker around in here, but when we look at a longer time frame, we see a mass amount of transactions happening right in this area. And then over here on the monthly, yeah, we wouldn't be surprised if I wouldn't be surprised if prices kind of stay sort of where they're at. So what I'm going to do, I'm going to put this on. I'm going to come over here to trade. And let's take a peek at option chain. I had said that we'll quickly define a call, and now is the time we'll do that. So this is an option chain. You see the date. You can see the date right here, and this number shows you how many days to expiration. So if you don't want to look at a calendar and count how many days until June 2nd, it tells you right here. Right? These are all these different dates, all these expirations. I'm going to start at the top, and then I'll work my way down to see what might interest me and just to get an idea of what the premium is like. So we got the expiration. You see it right here. Expiration going down this way. Strike prices. This is the price the stock could go up this way and go this way. You see how this is kind of this purplish color. This is this purplish color. This is black. This is black. See how they're kitty corner from each other? This is showing in the money on the call side. This is showing in the money on the put side. This is showing out of the money on the call side. This is showing out of the money on the put side. Now we sold puts at 67. That's how we got assigned, because it was in the money. Right? When I first sold it, it was out here. The stock started moving down. Right? Moving down. And eventually, right, if the stock were to move down, this strike price, 64.50, is not going to be black anymore. It's going to be this purple color because it's in the money. So that's basically what happened. And now we have ownership of it right here. But the stock is trading around right here. So that's what I was alluding to when I was saying that we're underwater with this position. But Brent does not stress out over this, because Brent has been underwater doing the wheel strategy before, and sooner or later I will be above the water. That's just how it works. I might have to put a little bit of time in. I might have to put some sweat equity and elbow grease in. But your good buddy Brent is not opposed to working hard and long, ladies and gentlemen. All right, so let's get on with it. 68. We're going to look at maybe selling the 68 strike, maybe even 67. But look at this. No premium. Bid is the side you sell at, and ask is the side you buy at. If you can't remember this. This is really easy to remember. You sell at the lower price, you buy at the higher price. But if the price is 0, you're probably not going to be able to sell there. Now we could sell here for a couple days, 5 days to expiration. Over here on the delta, it gives us a rough idea of how likely the stock is to move back up and close over this number, over 66.50 at the end of this contract expiration. And it's saying roughly about a 14% chance. I don't want to do that, for 5 days, because I can just look at this. How about for 12 days at the at the 67.50. Is there anything we can get? 1 penny. Oh, that's not looking too good. But look at this. On this side, this is called the bid-ask spread. The bid-ask difference between the two, the spread. And over here, look at the highest this option sold for was 7 cents. 7 cents. And the delta is telling us it's got about a 9% chance of expiring in the money. That's at 67.50. Now let's say for some reason XLU were to skyrocket up and end up being at like $68 or $69 at this contract expiration. If we sold the 67.50, not including the premium that we got from selling options, just on the capital gain from the stock, how much would we get? I know it's a trick question. However, let's walk through it. We bought the stock at 67. We sold the stock at 67.50. That's a gain of 50 cents times 100 shares, because we have 100 shares, right? If you don't remember, here it shows you right there, 100 shares. So what's 50 cents times 100? $50 before commissions and tax and all that nasty stuff. So maybe we could get 7 cents. The next option expiration date is 19 days. What could we get for 19 days? At the 67.50, the highest price it traded for on Friday was 15 cents times 100, right? Times 100. This is, and then equals $15. And the lowest was 11. And right now we got the bid and the ask at 7 and 25. So if we were to sell it at the 67.50, it's looking, the computer algorithm, mathematical equation stuff is telling us about a 13% chance of expiring in the money. This is volume right here. See, not this contract and this contract, lots of liquidity in there. Not as much over here at the 68. So what do you guys want to do? Right? The 68 sold for, let's just take a quick look at something. What's the mid over here? 13. We could potentially do that. Right? That would kind of be less, now it depends. How quickly do you want to get out? Are you happy to make $50 on the capital gain and potentially get out faster? Or would you rather wait longer and make $100 on the capital gain, even though it might take a lot longer? In the meantime, you're still going to be cash flowing because you can be selling options. So you kind of do it however you want to do it. And what I would recommend is look at the bigger picture of your life. Look at the bigger picture of your portfolio, what you have going on with that, and look at the bigger picture of just what you have going on with your life. You know, you got to bring kids to school, you're getting ready to go on vacation, whatever's going on, you match up the right stuff with you. That's what I do, my friends. It's not a one-size-fits-all. Selling cash secured put options on stocks you don't mind owning, as long as you have internet connection, bank account, you spend money at least once a year. That's pretty much one-size-fits-all. Everybody should be doing it. But as far as like little tweaky details of how you do it, yeah, you make it fit in your life. So why don't we try this out? Go for the 68. Just because I'm that type of guy. And we see the highest it sold for was 12, even though I think the mid was 13, right? Why don't we press our luck a little bit? We'll bring it up to 13. Let's see if we can get filled for 14 cents. Now, I know it's outside. I know we're asking for a lot. But what would have to happen in order for us to get filled for that? Let's talk about that in 1 second. I'm going to quickly change this over to good till cancel. And see we're selling a single, meaning one leg. We're not doing a vertical, which would be 2 legs, or iron condor, which would be 4 legs, la-da-da, different strategies. This -1 shows that I'm selling. If it's 0, that shows nothing's going on, right? Look at that. If it was 1, see how the color changes from red to green? Buy, sell. We want to sell. Sell and a call. We got good till cancel. We're going to send and confirm. I'm going to put this over here under long stock because that's how I like to do it. I move my stock over there. I want my open order to be right under that stock. Boom. We'll send it in, and I'll even show you how it's nice and organized now. Bam! There it is, telling me this is how I know that the contract has not been filled. Quantity 0, and we got a sell sign here. Now, what if I was selling two contracts and one got filled, like my good buddy Elizabeth happened to her the other day? So then, if you're selling 2 contracts and one got filled, you'd have a -1 quantity here, and you'd still have a sell sign there. And so, okay, we got that going on. Now, what would have to happen in order when the market price is around this 13, 13.5, something like that, and we're asking for 14? What would have to happen? Well, basically, really basic. One of two things, or a combination of two things. So volatility in general could increase, could make the premium richer because volatility increases, the vega increases, or the stock starts moving up. Combination of the two. If the stock starts moving up, that's going to make the 68 call more valuable, and if it moves up high enough, just with delta alone, might move it up to have get filled at that $14. And so what was our? We're looking at June 16th expiration. So down here, let's find June 16th. Boop. There it is. And look at this. June 16th, it is within the cone of probability. Oh, we're going the wrong way. No, it is not. June 16th. Where I'm so used to selling put options. Okay, June 16th. The 68 strike is just barely outside of the cone of probability. So if I wanted to have this stock called away from me faster and make that $50, then selling the 67.50 would be a better idea, right? Because see how it's in the cone of probability? Look over here. Look over there, right? Boom, right? There it is, just barely inside the cone of probability. And 68 is just barely outside of the cone of probability. So we're all set. We're all set. You know, I hope it was as good for you as it was for me, because I have a good time doing this. Just joking with ya. Come on, lighten up. Or get your head out of the gutter, whatever the appropriate funny statement is at the moment. Look at this. Probability of in the money, low. Right? Delta is it's not as accurate as when the computer program mathematical equation stuff does it this way. It gives you a rough idea, but we're looking at a little less than 10% chance of it happening. All I really care is if I get assigned, right? Like for this thing, get assigned, and then I'm sorry, not assigned. Get filled, right? Make this $14, get filled. It expires worthless. Hey, I'll sell another one. It doesn't expire worthless. I made the premium when I sold the put option. I got assigned. I made the premium when I sold the call option. I got assigned. Then I made some capital gain on it too. Whatever, you know, it's making money. Could I have made more money? Sure. But would you rather make zero, or would you rather make some? You'd probably rather make some, right? And you probably heard the stock market adage. It's very old, and it's very wise, and it comes from George Orwell's Animal Farm. And it goes like this. Bears make money. Bulls make money. But pigs get slaughtered. Okay, it doesn't come from George Orwell's Animal Farm. You know, 4 legs good, 2 legs bad. That one comes from the Animal Farm. I don't know if you guys have to read that stuff anymore in the public education system, but when I was a youngster, that's what I had to read. They made me read that. They made me read that stuff in the public education system back in the day when your good buddy Brent was walking uphill both ways in the snow of the cold Michigan winters. With that, ladies and gentlemen, I'm in the warm Hawaiian winters nowadays. Speaking of warm, I'm going in the sauna with my friend. You have a fantastic day. Bye-bye.